The consequences of not addressing climate change are, put simply, the planet will cease to exist in the way we know it today.
By now, it's clear that the road to net zero will not be easy.
This is not a problem that is only going to affect us in 2050, but one that is affecting us now.
Life will be enormously difficult for those that survive.
There is a heightened sense of urgency to drive towards a better world.
Is one of those things that on the surface can seem pretty straightforward.
We have to get from 51 gigatons of emissions yearly now to zero emissions, and we need to do it fast.
We have only very few short decades to address this existential threat to our existence.
So from an economic point of view, the impacts of climate change are here. They're starting to be perceived at very large scale.
Economic activity in the world will diminish dramatically.
So net zero is basically this idea of where we want the world to go, where we want companies to be.
Net zero just means taking out as much carbon from the atmosphere as you emit into the atmosphere.
And that's at the level of a single factory, or a whole company, or a whole portfolio, or even the whole planet.
Achieving net zero by 2050 at the latest gives us the best possible chance of staying within 1.5 degrees.
We're a long way from that future, but we know that it's possible and we know that it's what we need to work towards.
In other aspects of life where we maybe need to eat a little bit less, create a little bit less noise, do a little bit less of something, and that's sufficient. We don't have that in climate change.
So this next couple of years are absolutely critical to get towards net zero.
Why? Because we're in a race against time and a race against ourselves.
If we miss this tiny little window, we could be locked into temperature rise far above what we can even fathom.
And there hasn't been a threat of this magnitude in the history of mankind.
My name is Linda Eling Lee, and I'm the Managing Director and Global Head of ESG Research for MSCI. The need to reach net zero is clearly one of the defining issues in all of our lives, not just as investors, asset owners, asset managers, or the professional roles that we each occupy, but really as human beings. I'm going to be your guide through Net Zero Now, building portfolios for a 1.5 degree world. We're going to examine how investors can help us reach net zero, position themselves to thrive in a low carbon world, and to help the planet as we work towards keeping our global temperature from rising more than 1.5 degrees Celsius by 2100. We're going to look at the tools and the data that can help investors set and reach their net zero goals using real world examples. But before we get into the details of how to reach net zero, let's first establish what is the danger of not going net zero?
The Paris Agreement is a landmark international UN-based treaty that has been ratified by all 197 UN countries. Now, that's rare. We don't have very many of such agreements. And in the agreement, the countries have said that they want to limit global warming to well below 2 degrees, or if possible, 1.5 degrees of warming compared to pre-industrial temperature levels. Scientists are very concerned that once we cross that threshold, self-amplifying effects will take place, which might make the planet uninhabitable. We are currently on a path, a so-called business as usual path of 3.8 degrees of warming. And to limit warming as laid out in the Paris Agreement, we need to bring down all of our emissions by the year 2050. And that is a huge challenge, but it is still possible.
Imagine that we are trying to push a boulder uphill, and the hill becomes steeper and steeper, and the boulder becomes heavier and heavier. That's what's going to happen to us to try to push climate change issues if we do nothing. So the effect that we're having today of climate change, they're clearly manifested in many ways. One aspect that is very important is that the world is now warming up equally, the same way the sea level is not rising equally everywhere. Some places will be more exposed to more sea level rise than others. But in terms of temperature, we are to think that that's a global average world temperature. Places like the Arctic, they are now warming up at a pace that is double the rest of the world. We're already starting to see big changes in the Arctic, the consequences of this warm up. And some models project the Arctic to be warming up to 6-7 degrees Celsius with respect to the current or historical observations. There is a very strong divergence in terms of estimates of how much climate change is going to cost in the future. Some people talk about $300 billion in the next 20 years. Some others talk about tens of trillions of dollars for the next decades. One thing is for sure, our society relies on the economy to progress and to move forward, and the economy is not something that is independent from climate change.
There are many ways that investors and companies can get started on the path to net zero. So a year ago now, the United Nations launched a new campaign, the Race to Zero campaign, and that encourages business, cities, states, investors, insurers, banks, and many more to set a net zero target, as we're in a race against time and a race against ourselves. So what's interesting about the campaign is that you can't just say, yeah, I'm in, I support net zero. You actually have to commit to setting a net zero target and pledge that you're going to do it. And there's criteria in the Race to Zero campaign about the scope of that commitment. You also have to plan for action and disclose and publish how exactly you're going to implement that net zero target. And the way you can participate in Race to Zero is by joining an initiative that meets this criteria. And there's a couple of different options for investors already today. One example is the UN Net Zero Acetone Alliance. That's joined the Race to Zero for over a year. There's also a Net Zero Asset Managers Initiative, including some of the largest US passive managers in the world.
The Paris Agreement aligned asset base currently is very low. But what's important is that the number of funds and indices and climate-related financial products is growing by the day.
So investors can play a critical role in the transition to net zero by doing two things. The first is the reallocation of capital. This would entail moving away from the fossil industry towards the green economy and towards green solution. For example, supporting companies with achievable net zero targets. The other element is that investors, as shareholders of companies, have immense influence over the direction companies are going. But why should investors care about net zero?
Investors all over the world should care about climate change because their portfolios are a reflection of economic activity in the world. To the extent that climate change creates havoc on major sections of that economic activity, many of the companies, many of the bonds, many of the real estate that they invest in will be severely affected. There will be areas of major opportunities, but there will also be major areas of significant negative impact. And this is not something that is going to wait 10, 20, 30 years to happen. The repricing of financial assets, the reallocation of capital, it's already happening.
There are four dimensions for investors to consider. The first is that you want to minimize your transition risk, so ensuring that the companies you own are well positioned. The second is to maximize green opportunities, so making sure you focus on companies that will benefit from this industrial revolution. The third element is the reduction of physical risk. So appreciating your exposure to the various climate hazards and having a strategy to deal with them. Finally, is tracking and ensuring that the companies in your portfolio are aligned with a 1.5 or 2 degree trajectory. So this is really assessing the target for carbon emission reduction that each company would have. And then, if they don't have a strategy to manage climate change, exerting pressure to make sure this happens. Behind these four objectives investors need the appropriate tool and measurement to build, data models and carry out the required analysis.
With the question of why answered, we now need to move on to how. And this is a lot trickier. There's so much data out there, as well as so many problems to solve and so many opportunities to capture, that it can get a bit overwhelming. So to illustrate this, we have constructed a sample portfolio that uses MSCI World as its benchmark, whose constituents range across sectors and across regions. And currently, the implied temperature rise of the companies in this portfolio is about 4 degrees Celsius by the end of the century. So that's not as bad as many investors' portfolios might look in terms of its temperature, but it's certainly beyond the objectives that have been stated in the Paris Agreement. We will try to reduce the implied temperature rise of this portfolio. And to do that, we're going to need data. Lots of data. Data about things that can be really hard to measure, data that we can use, because when we talk about net zero and climate change, we're not just talking about where the mercury sits in your thermometer. We're really talking about balancing inputs and outputs, predicting things like weather patterns, water stress, potential regulatory action, and analyzing how all those things might impact companies now and in the future. As investors start their transition journey, they're going to need to know what's useful and what's not, what to tune out as noise, and what to pay attention to. So basically, to take this overwhelming, huge mass of data and really only look at what matters.
When I think about data and sustainability, I come very quickly back to that old adage of data deluge, but an information drought. We're operating at a time when we have access to unprecedented amounts of data, but we are still struggling mightily to be able to pull the relevant information out of those large data sets that can help us drive better, more informed, more sustainability-oriented business decisions. That is the role of the rise of modern day machine learning and the broader technologies of artificial intelligence. It's that ability to take very large data sets, confront those data with some of the most powerful algorithms the world has ever seen. And that, fundamentally, that is the role of computing. Data and technology will play an absolutely foundational role in every organization, every country, and ultimately the world meeting our net zero carbon goals. We've seen the power of digital transformation transform sector after sector after sector. We need to see that same type of transformation, that transformation of scope, scale, and speed, come to every organization's ability to track, monitor, and report out on progress towards carbon emissions reduction, the most important part of any net zero goal, but also carbon removals from the atmosphere. When we think about a massive societal goal like transitioning our global economy to a net zero carbon economy, what that means is first and foremost collaborating on definitions, what we mean by net zero. The next opportunity really is to help bring technology into the hands of customers and partners to be able to help them scale their work, both scale their work within their four walls, as well as scale their work outside of their four walls so that they can begin to empower their customers as well.
We're in a very complex industry that often needs to share data and technologies across the entire complex internal workflow systems and in partnership with other companies. Technology is evolving at an accelerated rate in cloud, NLP, data technologies, and so on. To keep pace, you need an open and agile architecture to take advantage of new breakthroughs and ensure that your clients always benefit from the latest technologies as fast as is possible. This also helps our clients integrate our solutions into their world in the way that suits them. So whether they need our data, research models, APIs, or user application, we'll let them pick and choose their approach in their own architecture in a very open architecture manner across our entire product line. So first, we need to collect data across a vast domain with high levels of precision, relevance, and in a very timely fashion. This is a very similar challenge to that of a search engine for news, for example. The second challenge is about interpretation of this data. What is the data have we collected by a mix of sophisticated technologies and humans? How do we put it into context? The third challenge is about providing transparency. And last but not the very least is the challenge of maintaining the highest levels of quality across millions of data points that we collect. The entire integrity of a rating depends on these constituents and our ability to transparently share our methodologies with our clients. We are partnering with Microsoft on cutting-edge natural language processing, large data lake and warehousing solutions, Power BI, and communication approaches across the industry, and so on. Our climate application, as an example, allows you to compare several companies in an industry to look at their carbon emissions, broken down by Scope 1 and Scope 2, targets over the years, the transition value and risk for various degrees of temperature change, their strategies of risk management, and also provides advanced search, natural language search capabilities to answer their questions. It provides a powerful search and UX using Power BI on top of 4,000 data points that we collect related to climate and ESG for a large number of companies.
Investors need to look at quite a lot of data to understand where they are today and where they're heading in their net zero transition, including scenario data, country data, company data, industry data. And one of the most important things to look at first are your carbon emissions, your Scope 1, Scope 2, and Scope 3 emissions.
Scope 1 emissions are all the greenhouse gas emissions coming straight from your business, your activities, and your operations. That's everything you have direct control over.
Scope 2 is all the emissions required to keep the lights on, all the emissions associated with the electricity that companies consume. And Scope 3 is everything else, and this is where it starts to get a bit tricky. Because these are all the emissions coming out of your value chain, and that is incredibly wide-ranging. Think of the supply chains you depend on to get all of your raw materials, to transport your goods, and to process your waste. And this is such a tricky proposition because you need to know very specific details, like where your IT equipment is made and how it gets shipped to you. I mean, think about the office's all-important coffee supply. Where does that come from? Where are the beans grown? Where do they get roasted? And then how do they eventually make their way to the office? For most companies, Scope 3 are the bulk of the emissions they generate, but they're so difficult to measure because of the lack of control the company has over them. So every number you see in the world for Scope 3 emissions, it's actually just an estimate, and companies have very different ways of estimating. And this variation in disclosures is a big challenge for investors. It becomes tricky for them to pull out the most meaningful signals. And especially in emerging markets, ESG and climate disclosure is pretty limited. So if you're basing your assessment on just what companies tell you, or if you say it's too hard and you just ignore Scope 3 altogether, you could be vastly underestimating your emissions. So what we've done at MSCI is been able to round out the data, fill in the blanks, and have a much more comprehensive cradle-to-grave assessment of carbon emissions. That's everything from using a team of experts to collect the data, having robust processes to verify different sources. We do a lot of cleanup work on the data, investigating outliers or discrepancies, as well as estimating data that doesn't exist today. We've worked on building out our alternative data sets, and that's data that doesn't depend on company disclosure. This makes it resilient to variations in data availability across different markets or different industries. So then the question becomes, how do you best aggregate all this data? What's the best standardized measurement to track your progress? Because companies will all have different levels of disclosure and different kinds of emission reduction targets. So the metric that we think helps the most with this challenge is called the implied temperature rise associated with your investments. Basically, you're computing. What are the forecasted emissions of the companies I'm invested in based on their targets, based on their past track record, and based on where they claim they're heading? And how does that compare to a global carbon budget based on scientific research of how much carbon we can continue to emit before we start to change global temperatures? And standardizing this implied temperature rise is so valuable because it lets stakeholders use a common language, and it shows investors how far they still need to go in order to align with a 3, a 2, or a 1.5 degree world.
The next question is, how do we actually apply data to maximize its usefulness? Data is such a crucial building block of investment solutions. And while there are certainly challenges surrounding it, such as interpretation, its transparency, its quality, with the right tools, you can really unlock its potential. So what are these tools?
In our recent publication, Breaking Down Corporate Net Zero Climate Target, we developed an analytical framework called MSCI Target Scorecard. This framework helps us assess the impact of corporate decarbonization target, including their net zero target. We observed about 1,000 companies setting new climate target in 2020, and 15% of them were already some type of net zero target. However, the devil is in detail. We found heterogeneous nature of corporate decarbonization target, and even slight differences in target description can make a huge differences in potential impact target could have on environment or a company's climate risk profile, even if the target were achieved. So clearly, framework was needed, and we created one.
This framework covers 3 possible dimensions of a company's target. Firstly, comprehensiveness. Secondly, ambition. And finally, the feasibility of a target. So to start, comprehensiveness. This entails being able to assess whether a target is covering all or a part of a company's footprint, including Scope 1, Scope 2, and all the categories of Scope 3 emissions. Then is ambition. How much emissions are companies aiming to reduce by, and how quickly they intend to do that? So we compare these projected emission reduction amounts and the company's target timeline against a net zero trajectory to 2050 to measure how far the company's footprint is off that pathway. Last but not least is the feasibility. And while it is hard to determine whether a target will be achieved, we can use additional information to inform the level of confidence. Specifically, we would look at historical targets and how a company has performed against them, together with progress against the current target. Additionally, we would look on how the company plans to achieve the target, perhaps through offsets or zero carbon products and services, or a combination.
So if we take a look at one of the company from the sample portfolio and analyze their decarbonization target using the MSCI target scorecard model, we can show not just short-term impact, but also long-term impact of their decarbonization target on their emission profile. So let's take a look at Intuit and their decarbonization target. This company targeted to reduce Scope 1 to 3 upstream and downstream emissions by 50% 2012 level by 2025 and 80% below 2012 level by 2050. If company achieve their short-term target, its emission level going to go down to 69% compared to 2019 level. And also please have a look at the long-term impact of the company's decarbonization target. If they achieve the target, the emission profile can go down to 28% compared to 2019 level. So good news is the company's emission trend suggests Intuit is on track to meeting all these ongoing targets, indicating high feasibility of success in achieving the target.
When thinking about the results of climate change, the physical effects are what would typically come to mind for most people. And we're going to touch on this element of risk shortly. But another major source of disruption is the risk that comes through policy changes and through market changes, what's also known as transition risk.
Transition risk presents itself in a few different ways. We need to collectively reduce the amount of greenhouse gas emission that we emit. And a lot of this limiting will come through policy regulations, for example, things like a tax on carbon, which would inevitably impact high-emitting companies as they need to reduce their emission unless they're willing to accept cost. And they would have to put new processes in place for their operations.
Aside from policy risk, there's also technological risk. Some of the products that were previously widespread are no longer sustainable in long term. So with a shift in market demand or new technologies emerging in the shift to a greener world, old technologies would become obsolete.
And for investor portfolio, then there's risk that for particular highly carbon intensive companies or sectors, they would become stranded. For an investor, the risk is that they're betting on the value of those assets and this value could be reduced to zero. Scenario analysis can help investors understand the possible impact of this transition risk, but also the opportunities associated as we shift to a low carbon economy. So the idea is to look at various climate scenarios that are not meant to be predictive, but they're more like a series of what-if questions. What will be the difference for a company in a world at 3 degrees of warming compared to a world with a 1.5 degree of warming? If we're in a 1.5 degree world, the policy risks become increasingly important, and there will be higher impact on the company's bottom line through higher costs and the cost of reducing drastically their greenhouse gas emission.
And this is where Climate Lab can come into play. The MSCI Climate Lab has a smart capability where you can select peers of the companies in your portfolio to evaluate them side by side and see which companies are best positioned for transition scenarios. So let's take a look at ArcelorMittal, one of the major companies in steel industry, and compare it with 5 of its peers. These 5 peers are based on their financial and ESG characteristics. The charts that you can see on the top pertain to the aggregated company's value at risk. This represents a company's aggregated climate value at risk, reflecting the value of a company's issued security under the specific climate change scenario. Here we have presented 1.5, 2 degree, 3 degree, and we can see what are the subcomponents that contribute towards this by hovering over the mouse to a particular company. As we can see over here, around 100% of ArcelorMittal's enterprise value is at risk in the 1.5 degree scenario. As we move towards 2 degree and 3 degree climate scenarios, we can see that while other companies do face reduced risk in terms of their enterprise value stressed against those risks, we can still see ArcelorMittal having around 100% of its value at 2 degree scenario, as well as a minus 71, which is one of the highest in a 3 degree scenario. If we look at the implied temperature rise for companies in this universe, we can see that ArcelorMittal fares somewhere in between as compared to its peers. As you can see that some of the targets that the companies have set does lead to a reduction in companies such as Sevestral, where from 8.7 it does reduce to 8.6. If we are analyzing ArcelorMittal, it does present one of the worst companies, and the company does have to act quickly. If it wants to move towards a low carbon transition future, it would face increasing risk on its enterprise value based on some of the model-based data that we have presented over here.
So this brings us to the forces of nature that comes with our changing climate. We see it in the increasing frequency and scale of physical risks, from hurricanes to wildfires that threaten company assets, such as our factories, offices, and infrastructure.
And there are really 2 types of physical climate risks, acute and chronic. Acute risks are sudden onset risks. So these are your hurricanes, your wildfires, or floods. And chronic risks, on the other hand, are the ones that will take a while to play out. For an acute risk, let's take the example of flooding. Obviously, there can be a small flood that disrupts business for a short period of time, or a huge disastrous flash flood, meaning that a company's operations have to be shut down for a long period of time, or in some worst case examples, forever. An example we use to illustrate chronic risks is to imagine a ski resort. And as the climate changes and the average global temperatures rise, less snow would fall over time, and the resort would no longer be able to operate. Climate Lab allows clients to drill down to individual asset locations and identify exposure to various physical hazards related to climate risks. Extreme cold and extreme heat, chronic physical hazards that will take a while to occur, tropical cyclones, which are expected to increase in frequency and intensity as climate change plays out, and baseline water stress, which is chronic water stress to a water base over a period of time, which can lead to a shortage of available water. So something that's hugely impactful for any business that relies on water. For every hazard except baseline water stress, we look at 2 timestamps, the current year and a 2050 projection. Let's see an example of how to use Climate Lab. I've chosen here Apple from our sample portfolio. The system defaults to extreme heat at the current time step. You can also then select the 2050 time step to get an idea of what things will look like in 2050. And because we're looking at extreme heat here, what this gives us an idea about is how much the temperature will increase over time. So let's focus on some of these offices that are in India. And one of the great things about Climate Lab is it captures all sorts of assets. As you can see, when you hover over the dot, you get the issuer name, the country, the GIC sub-industry, and the asset activity, which helps clients really understand exposure, because an office might be differently exposed than, say, a manufacturing plant, which might rely on water. Let's look at another example. Let's go to baseline water stress. So in this example, we're going to look at Merck and see what kind of exposure they have to baseline water stress. If you're an industrial asset and you can't access water that you're reliant on, you're going to have some issues. So in this example, let's focus in here on India. But we're going to go over to this one right here, which is an industrial complex. And as we can see, if we zoom in, this asset is exposed to extremely high baseline water stress. If we look over here in Ireland, where there's low exposure, we can see that there's a manufacturing plant of Merck's over here. And that's probably something that an investor wants to know, because this plant would not be exposed to baseline water stress. Climate Lab will help clients better understand the overall exposure of the constituents within their portfolio.
We've talked a lot about how climate change will inevitably mean multiple dimensions of risks. It's important to remember that this deep transition for our economy does actually offer opportunities to the investor as well.
When you look at all previous industrial revolutions throughout history, they were always driven by two things: new technology and capital. And today with NetZero, it's no different. We need a technical revolution, and we need a lot of capital to drive it. Now, with this revolution, investors need to be aware that we can expect a lot of creative destruction, to use the words of the famous Austrian economist Schumpeter. So this means that some old technology will disappear. And for investors, the challenge is to understand how to identify these risk exposures and how to identify the opportunity exposures. So we looked at economic literature to begin with, and there is this argument, or this causation chain, as academic researchers call it. And basically it says a lot of companies are investing to build green technology and power rights. And ultimately, early on, these investments leads to new green technology, which means they have new green patents. And these patents are then used to build new products, green products. And these green products are eventually used to create new earnings, and that should create earnings growth for companies. So to test this causation chain, we used our green patent score as an early indicator, because green patents, they will come long before a company might be able to monetize green technology through new products. But then we used also a late indicator, which is the green revenue shares of companies, which is a late indicator in the causation chain. Now, for both of these indicators, we looked at companies that have a lot versus companies that have very little or none. And what we found is that for green patents, there was a little bit of evidence that companies with more green patents were able to grow their earnings and have better stock performance than companies that have no green patents, but the statistical confidence was very, very weak, to be honest. But then with the second indicator, green revenue share, we found that companies that have green revenues, basically they already have green products and they sell them, the earnings are on the balance sheet, they had better earnings growth and better stock performance. So in this chart here, we compared companies with a lot of green revenues and companies with less green revenues in each sector. And you see the difference in their earnings growth and stock performance over the past 7 years. And what you can see here very clearly is that companies with more green revenues clearly outperformed in terms of both stock performance and earnings growth over the past 7 years. And what is really interesting, this outperformance was by far the strongest in 3 sectors: utilities, materials, and energy, which is quite funny because these are actually the 3 most carbon intense sectors. So these are the sectors where most of the carbon emissions sit. So what it tells us is that over the past 7 years, it makes a huge difference whether the company was an early mover into green tech or whether it was a laggard. And so all this teaches us, the lesson is that this new industrial revolution, it's already on its way. It's already showing up in the data.
Of course, while we all have the 1.5 degree target and we need to plan for the future to 2050 and beyond, we can't predict exactly how the next 30, 10, or even 5 years are actually going to go, and what form this new industrial revolution is going to take. It's a transition that's going to take time. And during that time, carbon offsets will play a crucial role. MSCI has developed a tool to help investors visualize how offsets might affect their portfolio and help move them along the path to net zero.
So with net zero being the number one concept in climate change, the question, what is a net zero portfolio, is extremely natural. Of course, many investors are asking themselves, what is the announcement that they can make? Can they claim that they will be net zero in 2050? Can they claim that they will be net zero before that, maybe in 2030? And calculating that is not easy. The net zero target setting tool that we have developed helps investors to determine in what year their portfolios will be net zero, what the strategy for the decarbonization and the offsetting will need to be. So let me walk you through an example how the net zero target simulation tool can be used to devise a net zero portfolio strategy. So I have chosen the MSCI ACWI index and its climate Paris aligned version, the MSCI ACWI Climate Paris Aligned Index. So now I, as an investor, have chosen as an example to net zero my scope 1 and scope 2 emissions and not to reduce my scope 3 emissions to net zero for now. I have defined a decarbonization rate of 12% per year, which means that each year I'm going to commit to reducing my carbon emissions by 12%. And I have defined an offsetting strategy where I said I would be willing to pay $100 per ton of CO2 offset, and I would offset up to 100 tons of carbon. And I'm applying that to a $30 million portfolio value. And what the tool shows you is the emissions profile of those two portfolios. And you can see in the blue line, with the blue line, the MSCI ACWI index, with the yellow line, the Paris Aligned index. And you can see how the Paris Aligned index starts from a much lower point in terms of the emissions. Of course, in the beginning, I would start, both portfolios would start offsetting the full 100 tons because the total portfolio emissions exceed that 100 tons. But you can see with the yellow line that it starts decreasing much earlier than the blue line. Also, the cost is calculated and the net emissions of the portfolio are calculated. And in the summary statistics, you can see the interesting part that the MSCI ACWI index would be net zero in the year 2044 with that strategy. But the MSCI ACWI Paris Aligned index with this decarbonization strategy would be net zero in the year 2030. So that's an excellent target year. And that's how investors can see that the cost would be quite limited, would be 3 basis points. Investors can use this tool to evaluate their strategies because it's very important for them to be able to define, is the cost going to be prohibitively expensive and is the target year aligned with what they would like to announce.
When the Paris Agreement was first signed in 2015, there were actually very few investors who even knew what their carbon footprint was. Now, we've really come a long way since then in terms of understanding what the different dimensions of risks are that are associated with climate change. We've also really come a long ways to identify and measure where these different dimensions of risks could reside in an investor's portfolio. Now, of course, we also have a very clear goal that we're shooting for. It's for an investor's entire portfolio across all asset classes to stay well under a 2-degree temperature rise, preferably a 1.5 degrees. But even as our understanding has improved a lot and how we measure investment risks associated with climate change has become much more sophisticated analytically, I think investors and companies are now running out of time to mitigate these risks. And they really need to urgently shift into a mode where they can affect large-scale decarbonization. And that's why you're seeing greater adoption among policymakers around the frameworks that are set out by the TCFD, especially now leading into the COP26 this year. This Race to Net Zero campaign is gaining momentum across the capital market value chain. So for asset owners to investment managers to banks and more, everyone is really setting a commitment to race to zero. Now, where the first problem lies with this is that the different assets and the different portfolio companies obviously contribute quite differently to that total portfolio emission. And each of them has a very different limit and opportunities in how much and how quickly they can actually decarbonize. Every company is going to need to set its own net zero commitment, its own path, which can cover all of its direct and indirect emissions. That spans across the entire value chain. But today, very few companies actually have set these targets. So for investors, the question is, how do you actually implement a portfolio where the different parts within the portfolio don't actually have yet this commitment to get to net zero? So basically, how can you project the progress that you need to make at the portfolio level if you don't have any level of assurance that the companies in the portfolio are going to make these kinds of ambitious commitments and actually take concrete steps to reach those commitments? So that's a gap between investors who have top-down ambitions to reach net zero across their portfolios and the bottom-up view of companies actually taking insufficient action so far to realize their ambition. Well, one approach was simply to say, well, I would like my portfolio to look like what it should look like in a net zero economy, really setting concrete target at that end state and then constructing a portfolio that really meets that preset target. So we could illustrate this with what we would call an index-linked approach. Now, a second approach would be where, depending on what kind of investor you are, how widely invested you are, you may want to take a more active view in terms of how you maybe select just those investments in the companies that could really benefit more actively from the transition. And then you could then actively and over time overweight your exposures to a higher concentration of those companies. So we would call this approach choosing a net zero glide path. And finally, we know there are a lot of investors who take the point of view of a large universal owner whose portfolios reflect the full diversification of the world economy. They don't really have the luxury of diversifying away from any externalities. So these investors believe in corporate change. They have to believe in corporate change in order to reach the desired outcome for their entire portfolio. So the problem for them really is in identifying the companies that are maybe the furthest from changing and maybe most in need of change in order for the investors to actually meet their objectives of a net zero portfolio. So engaging with companies, that's the final approach that we will discuss. Let's start by talking about indexes.
When we talk about the transition to net zero, we've seen that there are important elements investors should consider, such as minimizing transition risk, maximizing green opportunities, minimizing physical risk, and ensuring that companies within an index or portfolio are aligned towards a 1.5 or 2 degree trajectory. MSCI's custom index capabilities can help investors incorporate these objectives in their net zero index solution. Now, let's look at 2 potential index-linked approaches that center around decarbonization as a way to achieve a net zero transition. The first option is a periodic rebalancing towards lower emitting companies. So let's examine a case where we look at companies along segments of higher emitters versus lower emitters. Over time, we're going to eliminate the higher emitters and start adding companies that are lower emitters. Now, the benefit of this example is that it's quite simple. It only requires periodically updating historical carbon emissions data per investment, and a portfolio construction methodology that at each rebalancing date shifts more capital from high emitters to low emitters in order to achieve the desired annual decarbonization target. The challenge, though, is that over time, it doesn't necessarily shift capital towards companies that decarbonize themselves. So it could lead to a manner of concentration. And this concentration is because it can be easy to remove those companies that are higher emitters, but perhaps there aren't as many companies that are in the lower emitter segment. And interestingly enough, it could also be the case that some of the companies that have, for example, green opportunities or green technologies could very well be those companies that are currently in the high emitter segment. So these increasingly concentrated portfolios capture an ever smaller fraction of the market in the long run, and in the most extreme scenarios, could lead to a divergence between the net zero portfolio and the broader market. Given that, let's look at the second option, shifting capital towards companies that are self-decarbonizing at each rebalance. These are companies that are reducing their emissions over time, even if they're still relatively high. We see that we don't wholesale remove or change the weight in some of these companies that are higher carbon emitters. We start changing them gradually over time. And this is perhaps a bit more challenging, as it requires forward-looking estimates on companies' decarbonization pathways. But the benefit or the hope is that we would have a portfolio or an index that would have a risk profile more similar to that of the marketplace, while at the same time taking advantage of opportunities in green solutions. If you'd like to see how decarbonization and other ESG strategies would have affected the past performance of some of MSCI's benchmark indexes, we have a tool, Index Builder, that will allow you to do just that and much more. The takeaway here is that an index-linked approach is a great way for investors to reduce the carbon intensity of their portfolios over time while adhering to their desired risk and performance characteristics.
Once an investor has decided to pursue a net zero objective, it's important to define a glide path that helps them reach it.
In order to define a glide path, there are three different variables one needs to look into. These are, what investment should I look into in order to get my portfolio closer to the net zero objective? What time frame do we expect this transition to take place? And once we decide on the time frame, then we need to be comfortable with the cost that you're going to incur for making that transition. That cost is not just the transaction cost that we would incur. It is also the increased return or the decreased return that we would incur as a result of making those decisions. And defining these three variables will then enable us to create a glide path. So my objective now is to define how to get to a glide path using MSCI Barra 1 and MSCI liquidity metrics to help you choose your investments, to evaluate the cost of different time horizons, and how do you make the trade-off between time and cost. When we define the portfolio glide path, we need four different things. Time to net zero, the opportunity cost, the gains and losses that you're going to make, and whether we account for any deviation and how. The cost of transaction and how do we want to execute? Do we want to execute monthly, quarterly, 6 months, annually? So what is the transition we're talking about? We're talking about a beginning portfolio that has a very high temperature impact of 3.5 degrees. We're trying to get that to 1.5 degrees. So what does it mean? I use an optimizer, start with the starting portfolio, and I identified how much do I need to trade on this portfolio in order to make it compliant, and what assets am I buying and what assets am I selling to achieve that outcome. While it looked very simple at the top level, once you zoom into the portfolio, there is substantial variation in the temperature of the portfolio. Some assets have as much as 10 degrees impact, some assets are closer to the 1.5 degree mark. I took the portfolio through our liquidity module, and then I said, as time changes, how does the cost get impacted? And you can see, if I do it instantaneously in one day, it's extremely expensive. On the other hand, if I were to do it over a year, it's roughly a seventh of what we started out with. So when I investigated further, I found that the cost of a large cap and a mega cap, on average, is about half the cost that you'd incur on smaller assets. So it's important to understand these assets. And if I have a number of these assets, then purely from a transaction cost perspective, my cost of transitioning is smaller. There is obviously significant skill in execution. And when individuals execute at the best timing, it is possible to do better than a very blind 100% selling of the asset at any given point in time. So then we looked at sectors, and we wanted to see, because the sector profile of the portfolio is changing quite significantly. For example, we're going from quarter of the portfolio in information technology to close to half in information technology. We are exiting energy stocks. You can see energy has a significantly higher cost. You can see healthcare has the lowest cost. And we would like to use this extra information in order to to decide what to trade and when to trade. When we looked at the transaction cost over that time, we find that almost all of the sectors get closer to their lowest values around the 3-month mark, excepting energy. Energy tends to have a higher cost throughout that, and it kind of converges down at the 2-year mark. So our conclusion at this point is we are going to transact around the 3-month mark, excepting energy. We're going to transact large cap and mega cap first, and that can even be less than 3 months in the case of the portfolio that I looked at. And we're going to transition towards a net zero portfolio. So now when you look at the final portfolio, I have the in blue, the final portfolio and the temperature change impact for all the assets. And I have all of the assets that I've had to get out of to get to this portfolio on a 30-day transition plan.
Finally, we look at how investors can engage with companies, evaluating their path to net zero and whether they're ahead of or behind the curve.
Some companies are still debating whether to take climate risk seriously at all. These challenges bubble up through issuers up to the portfolio level. Given how widespread they are, there's no way for investors to simply optimize their way to net zero today. It will take engagement and accountability as well. So where to start with engagement? As a first step, it might make sense to see what level of climate risk the companies in your portfolio actually face. At heart, this means greenhouse gas emissions. Are they high compared to peers? Are these emissions from their own operations, or are they embedded somewhere else in the supply chain? Another indicator could be who the decision makers are related to climate risk. If it's not the board or C-suite executives, why not? And on performance, what's been happening recently with emissions? Has the company been reducing its greenhouse gas emissions over the last 3 or 4 years, say, or have they been growing steadily over time? If companies have set climate targets at all, how ambitious are they? And how credible is the strategy to reach them? Are solutions to decarbonize today already available? Or are they banking on someone else coming up with a breakthrough in 2045, a technological moonshot to save the day at the last minute? Finally, taking all of this together, are companies investing today in ways that help them reduce their climate risk now and in the future? A lot of companies have 30-year CapEx plans, so investors had better start engaging with them now. If we take a look at a company in our sample portfolio, we might take a look at Deutsche Post, for example, a large mail carrier and delivery service, and look at the climate risk that it potentially faces over time. One way to do this is through the climate value at risk measure. And in a 1.5 degree scenario, which is in line with the Paris Agreement being well below 2 degrees, you see they face significant risk, not as much as some peers, but up there. And this suggests with the overlay here that a lot of this comes from policy risk. So Deutsche Post operates in countries where the carbon price might increase or policies are going to be constraining carbon over time. They don't have very much upside from the tech opportunity point of view, and they face moderate risk from extreme weather and other physical risks. So if we have a starting point that Deutsche Post climate risk is rather serious and is something that investors could pay attention to, then maybe we turn next to performance and look at emissions over time to see, again, are there emissions in their operational emissions, which they have direct control over, or are they embedded more in the value chain, which could or could not be harder to mitigate, reduce. So looking at scope 1 and 2 intensities, Deutsche Post is well above all peers, and they've been relatively flat over time. But I think what stands out is actually their scope 3 total emissions. Is partially due to the very large size of the company and its focus on, or its partial dependence on air travel, air emissions. The company's scope 3 emissions make up 75% or more of their total emissions. And the majority of this, the overall emissions, are actually from the planes that they fly to deliver their mail. And you can see here that here, compared to peers, they have much more emissions from purchased goods, which again is from the trucks that they drive, the planes that they fly, and the ships that they use also. So Deutsche Post faces a significant challenge in reducing its emissions over time. And they've addressed this through targets. So In March 2021, the company came out and said, we are going to reduce 100% of our emissions. We will be net zero by 2050. And in order to get there by 2030, we're going to invest 7 billion euros in carbon neutral technologies. And this could help them, but there's a difficult road for them to travel. So if we look at the company's targets, so they plan to reduce 100% of their emissions by 2050 over most of their value chain. But for an investor looking at this company, one question might be, how are you going to reduce the emissions from air travel, which make up the majority of your emissions, right? So there are no easy solutions there as they now exist. And this is a challenge that Deutsche Post is going to face as a company and as a company is committed to net zero by 2050. The pathways aren't easy, and this may be a good opportunity to begin an engagement.
Reaching net zero by 2050 is crucial if we are to continue to live and thrive in a world that is recognizable to us today. We can get there, but only if we all work together and only if the owners of capital allocate it to companies that will help further a carbon neutral world. As we move towards COP26 later this year, we really are on the cusp of a tipping point for nature, for our economy, and for the world. At MSCI, we hold ourselves to the same high standards that we use to assess issuers' climate risks, and we have committed to achieving net zero before 2040 throughout our global operations. We call on all stakeholders to embrace and accelerate this revolution away from fossil fuels and toward a net zero economy. We hope you're going to join us in that call and that you now feel that you have a practical grounding on how to start this transition.